IBIT or FBTC, if you want Bitcoin exposure through a traditional brokerage account in 2026. These are the two biggest names you're likely to encounter. And at first glance, choosing between them seems almost pointless. Both are designed to give investors exposure to spot Bitcoin. Both charge the same headline fee. And if Bitcoin rises or falls dramatically, that underlying move will dominate what happens to either investment. But the wrappers are not identical. Liquidity, fund size, trading efficiency, custody structure, and even the platform you already use can make one more suitable than the other. So this comparison is not really about predicting which ETF will magically outperform. It is about determining which structure better fits the way you invest. And the easiest place to begin is with the basic numbers. Start with a snapshot. IBIT is the iShares Bitcoin Trust ETF from BlackRock's iShares business, while FBTC is Fidelity's Wise Origin Bitcoin Fund. Both currently charge a sponsor fee of 0.25%, but their scale is very different. As of August 7, 2026, IBIT had roughly $48.4 billion in net assets. Fidelity reported FBTC at roughly $10.2 billion as of June 30th. So keep in mind that those AUM figures come from different reporting dates. The important point is not the exact dollar difference on any given day. It is that IBIT operates at substantially greater scale. That immediately raises a reasonable question. If IBIT is much larger, is it also cheaper? Surprisingly, this is where the comparison becomes almost boring. On headline fees, there is no meaningful winner. IBIT charges 0.25%, FBTC charges 0.25%. That means a $10,000 position implies roughly $25 per year at that rate, while $100,000 would imply roughly $250 before considering trading costs or changes in the value of the investment. So if your entire decision is based on the expense ratio, you have reached a tie. And that matters because investors often spend too much time comparing tiny fee differences while ignoring costs that can matter more in practice. For someone buying once and holding for years, those differences may remain small. For someone trading frequently or moving larger amounts of capital, execution becomes much more important. And that is where IBIT starts separating itself. IBIT's clearest structural advantage is liquidity. As of August 7th, its 30-day average trading volume was about 35.7 million shares, and its 30-day median bid-ask spread was just 0.03%. Why should you care? Because an ETF's expense ratio is not the only cost you face. When you buy or sell, the difference between the bid and ask price can affect execution. For a small, long-term investor making occasional purchases, that difference may be almost irrelevant. But as order size and trading frequency increase, deeper liquidity and tighter spreads become more valuable. So IBIT's advantage matters most to active traders, institutions, and investors moving larger positions. But liquidity is only one consequence of scale. IBIT is also dramatically larger than FBTC, and that creates another comparison we need to interpret carefully. IBIT's roughly $48 billion in assets makes FBTC's roughly $10 billion look small by comparison, but do not make the mistake of interpreting that as $48 billion of safety. A larger Bitcoin fund does not make Bitcoin less volatile. If Bitcoin drops 40%, having a bigger ETF wrapper does not magically protect you from the underlying asset. What scale can provide is a larger trading ecosystem, more market activity, and potentially better execution conditions. It can also be a signal that a product has gained significant institutional adoption. Those are legitimate advantages, but they are operational advantages, not guarantees of superior investment returns. Both funds are ultimately trying to give you exposure to the same highly volatile asset. And beneath that exposure sits another layer that most ETF comparisons barely discuss: who actually safeguards to Bitcoin. This is one of the more interesting differences between the two products. IBIT currently uses Coinbase Custody as the custodian responsible for safeguarding its Bitcoin. It has also designated Anchorage Digital Bank as an additional available custodian, although BlackRock's filings state that it currently has no plans to move Bitcoin there. FBTC takes a different approach. Fidelity Digital Assets, an affiliate of the sponsor, serves as its Bitcoin custodian. FBTC also has BitGo available as an additional custodian, while Fidelity's prospectus says the fund's Bitcoin is currently held with Fidelity Digital Assets. For the shareholder, the important distinction is simple. You are not personally holding the Bitcoin or controlling its private keys. You own shares in a trust whose Bitcoin is held through institutional custody arrangements. And Fidelity's arrangement leads to an obvious question. Is having custody inside the Fidelity ecosystem actually an advantage? For some investors, Fidelity's integrated structure is one of FBTC's strongest qualitative arguments. The sponsor is part of Fidelity's ecosystem, and Fidelity Digital Assets acts as the primary Bitcoin custodian. That may appeal to investors who prefer having more of the operational chain within one corporate ecosystem. But there is an important distinction. Integrated does not mean risk-free. Custody risk, cybersecurity risk, operational risk, and counterparty risk do not disappear because related entities sit under the same broader organization. And an in-house custody model does not give FBTC a reason to generate higher Bitcoin returns. Think of this as a structural preference, not an expected return advantage. If you value Fidelity's ecosystem, it may matter. If you mainly care about trading efficiency, IBIT may still look stronger. But what about performance itself? Could one consistently beat the other? This is where investors need realistic expectations. Both products are designed to give you exposure to the price of Bitcoin. While expenses and operational factors create some drag, they do not use exactly the same reference rate methodology, so small differences can appear between their reported NAVs and tracking results. But over the long run, the dominant force should still be Bitcoin itself. If Bitcoin has a massive year, both should broadly reflect that move. If Bitcoin collapses, neither wrapper solves the problem. What you should monitor instead are things like tracking difference, premium or discount to NAV, trading spreads, and fees. And one more point that sounds obvious but regularly confuses new investors. A lower share price does not mean an ETF is cheaper. The dollar price of one share tells you almost nothing about whether IBIT or FBTC offers better value. So, with performance unlikely to create an obvious winner, investor profile becomes much more useful. Before we separate those profiles, one quick interruption. If you like investment analysis that looks past the ticker symbol and into what you are actually buying, subscribe to Boring Money Wins and hit the like button. We cover Bitcoin, ETFs, stocks, REITs, bonds, retirement accounts, and long-term investing without turning every decision into hype. Now, back to IBIT versus FBTC, because once the basic similarities are removed, the easiest way to choose between them is to ask what kind of investor you actually are. The case for IBIT gets stronger when trading efficiency matters. If you trade frequently, place larger orders, or simply prioritize a very deep secondary market, IBIT's scale and liquidity are meaningful advantages. Its high trading volume and very tight recent median spread provide a strong execution environment. That does not mean every IBIT trade will automatically receive a better price than every FBTC trade. Market conditions change constantly, but structurally, IBIT currently has a larger trading ecosystem. For a long-term investor buying a few $100s at a time, that edge may barely affect the final outcome. For a trader moving much larger amounts, it can become more relevant. So think of IBIT's strongest case as liquidity and scale, not superior Bitcoin. And if maximum liquidity is not your priority, FBTC becomes much harder to dismiss. FBTC remains a very credible choice, especially for long-term investors who already operate inside Fidelity's ecosystem. You get the same 0.25% headline fee and straightforward spot Bitcoin exposure, while Fidelity Digital Assets handles the primary custody arrangement. If you already use Fidelity for your brokerage or IRA, having the Bitcoin product inside that familiar environment may simplify portfolio management. But convenience should not be confused with higher expected returns. FBTC does not get better Bitcoin because Fidelity is a sponsor. And if you buy infrequently and hold for years, IBIT's enormous liquidity advantage may not materially change your outcome. That is why this comparison has no universal winner. IBIT can have the stronger market structure for trading, while FBTC can remain perfectly rational for buy-and-hold investors. Unfortunately, whichever one you choose, the largest risk remains exactly the same. The biggest risk in IBIT is not BlackRock, and the biggest risk in FBTC is not Fidelity. It is Bitcoin. Bitcoin can experience extreme volatility, and putting it inside an exchange-traded product does not change the economics of the underlying asset. The ETF-style structure makes Bitcoin easier to access through a brokerage account, but it does not make the asset stable. There's also an important legal distinction. Although these products trade like ETFs and are commonly called Bitcoin ETFs, neither trust is registered as an investment company under the Investment Company Act of 1940. That means investors do not receive all of the same regulatory protections associated with conventional registered ETFs and mutual funds. You also do not control the private keys. So before debating IBIT versus FBTC too aggressively, there is an even more fundamental decision to consider. Do you want Bitcoin exposure through a financial product, or do you want to own Bitcoin directly? A Bitcoin ETF-style product and self-custodied Bitcoin solve different problems. With IBIT or FBTC, the experience looks familiar. You buy shares through a brokerage account, and products like FBTC can also be purchased through eligible retirement accounts such as an IRA. You do not have to manage seed phrases, wallets, or private keys yourself. That convenience is a major advantage. But convenience comes with a trade-off. You own shares in the investment vehicle, not Bitcoin that you can withdraw to your own wallet. Direct Bitcoin ownership gives you control of the asset and its private keys, but that also transfers security and custody responsibility to you. Neither model is automatically superior for everyone. They solve different problems. And once you decide that an exchange-traded Bitcoin product is the structure you want, the IBIT versus FBTC decision becomes much easier. So, IBIT or FBTC in 2026. If maximum liquidity, market depth, and efficient execution are your priorities, IBIT currently has the stronger overall case. It is significantly larger and trades within a much deeper ecosystem. If you are a long-term investor who already uses Fidelity and values its integrated Bitcoin infrastructure, FBTC remains a strong alternative. And because both charge 0.25%, there is no major headline fee advantage separating them. For most buy-and-hold investors, though, I would focus less on trying to find the microscopic winner between these two products and more on a much bigger decision: how much Bitcoin belongs in your portfolio in the first place. The difference between a 5% Bitcoin allocation and a 25% allocation will probably matter far more to your portfolio risk than choosing IBIT instead of FBTC. Choose the wrapper that fits your needs. Then manage the exposure. Because the ticker is the easy part. Risk management is where the real decision begins.